You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. How are you doing today? We're almost done for the year, and I thought of looking at all my stocks, just to see what were the best performing companies in my portfolio, and the worst one, of course. So I've selected only like one bad stocks per market, so one bad for Canada, one bad for US. Mostly because in a year where the market is up by more than 20%, you don't have that many losers in your portfolio. I don't know. I was looking at mine and I'm like, Couche-Tard, for example, did not have a great year, but it was still up like 3%. Toromont Industries sucked at -2. I got Stella-Jones. That was not that great, but I mean, it's not that bad, especially when you look at the top performers. So today I just want to share like the top performers that happened in my portfolio. And I would like you to do the same on YouTube. So as you know, those podcasts are also published on my YouTube channel at The Dividend Guy. And you can actually share those thoughts with me in the comment. That would be fun. Just to of course, it's just a year. I just want to highlight that big time. It's just a year. Most of it is luck because it just happens over like this 12 months. And then the next 12 months could be completely a different story. For example, CIBC and Scotiabank this year, they're not in my portfolio, but they did incredibly well. But last year, they did incredibly bad. So they're just recovering. So that explains a part of their upside this year. It's just that last year it was down big time. And on top of that, 24 has been a crazy year in the market. So, of course, they went up, but it also explains what happened. What is more impressive, in my opinion, is a company that does well year over year. So I'm going to start actually with the best performing stock in my portfolio. I did that quickly, so maybe I forgot one, but I mean, it was just like for a fun episode to highlight a few stocks. Ironically, this one is exactly in the same situation as CIBC and Scotiabank, and it was Capital Power. Capital Power, CPX, a utility business, had a terrible year last year. Like went down, I can't remember how much, but it was not a good year. And this year is skyrocketed. Good news, up 75%, including the dividend year to date, which is kind of crazy. Bad news, that is part of my Smith maneuver. So I had like a few $100 invested in it. So I did not feel it. It was just like the Smith maneuver that I run is a fun experiment for me, but it's not like something that is like super important. And of course, I mean, I invest like $500 a month in this project. So all my positions are now around $1,000, $1,500. So if it's up 75% or not really worth it, but I thought of highlighting it because maybe I have other investors that are listening to the Moose that could cheer with me and had a real position in Capital Power. So kudos to you, my friend, because you made a pretty good year. On the Canadian side, and this is a fun exercise. So I looked at my portfolio first, and then I tried to guess which one was the best performing in my portfolio. And I thought, while looking at all my Canadian stocks, I thought that my best performing would be Constellation Software. This thing is a beast. It's growing by acquisition, and it has like a unique business model where their business model is to acquire technology companies, but very small one. We're talking about like 5 to 50 billion deals. So acting like a venture capitalist firm, but for like tiny deals. And they're like bits and pieces, buying them over and over and over again. They have a perfect playbook for that. And that's why they call it Constellation, because they run like hundreds of companies. They do it so well that the company keeps on generating like a lot of revenue, a lot of cash flow, and it grows like incredibly. Downside, not increasing its dividend. So this one was on my radar for a very long time, but I resisted to buy it, unfortunately, for several years, mostly because it was not a dividend grower. But then I decided to do a deep dive because all the other metrics were amazing. And then I realized that the lack of dividend growth here was not because they cannot afford it, but it's a decision of capital allocation. So they just find they can use their capital to generate even more value for shareholders by making more acquisition instead. So therefore, I'm all in for this one. Surprisingly, this was not my best performing stock. This one is up 42%, so still pretty good. But the winner on the Canadian side is Brookfield. Brookfield, BN.TO, so Brookfield Corporation, the parent company that owns everything else, did not had like great years in the past so far, over the past 2-3 years, but this year it's up 60%, which was crazy. So great year for the company, the business doing well, but it's always been doing well, actually. It's just that now it's getting love from the market. So very, very good year on the Canadian side, but those two performers were amazing. Worst performer on the Canadian side, this one was really easy to guess. TELUS. Again, minus 10%, including the dividend. Very bad. Very, very bad. The last drop over the past couple of weeks, hurt. I already discussed TELUS over the past 2 days. Actually, at the beginning of this week, so I'm not going to talk about it today. But yeah, not happy there. Down 10%, still following the metrics to see what's going to happen moving forward. But definitely not a great stock in my portfolio so far. On the US side, I do have a lot of great winners. Again, I tried to figure out which stock was the best one. And I was right on this one, though. It was Lemaitre Vascular. It's a small cap, no debt, niche market. I talked about it several times at Dividend Stocks Rock. I added it I'm not even sure if it was at the end of 23 or at the beginning of 24, but the stock is up 59% this year. Was up on its way to was up more than 90% in November, but recently the stock price dropped a little bit. That's something that happens from time to time with small cap. You have to deal with that too. A lot of volatility. Still an amazing business. The company this year reported very strong double-digit revenue, earnings, dividend growth rate. Again, growing in a niche market by acquisition with absolutely zero debt. I'll just love that kind of business model. Repetitive purchases. They're dealing with hospitals. They're serving like surgeons and other doctors. So great business if you want to look it up, LMAT. After that, we add two other special mention that I wanted to give. One that is ironically not a dividend payer, Amazon. I bought Amazon in 2016 or 2017 after I reviewed Walmart and Target, and then decided that Amazon was the best pick in that sector. So up 51% this year. Too bad it's not a dividend payer, but anyways, I mean, still great performance over there. And another dividend payer that did incredibly well this year and starts to get me on my toes right now, because I'm a bit skeptical. Sorry, I really have a hard time with this word. Sorry, guys. Very hard time with this one. Costco is up like 49%. Great year, but the PE expansion on this one. Yeah, that's a tough one. Like, I don't know what to do with this one. It's really rare that I see such a strong expansion of PE. In other words, that investors today have to pay a higher multiple for their earnings versus what it usually is. Has always been expensive in terms of multiplier of earnings. So the PE ratio was always really high, but now it's getting higher and higher. So I don't know about this one. But anyways, it's up 59% in my portfolio. It's up by more than that because I've been running this one for a 2 full year, maybe a little bit more than that. So like just good news for me, but still I'm a bit worried about this one considering the valuation. And on the downside, I had Starbucks, which actually was a lot worse during summertime at minus like 20%. Now it's down by 1.2, 1.5, well, let's say like down 2% this year. So definitely a bad year comparing to the market. But at least it's going towards the right trend, I would say. So yeah, not a big performer. They are running through a restructuring plan, change of CEO, struggling same-store sales in China and in the US. A lot of headwinds, a lot of challenges. But I think that I can allow myself to be patient. I'm still up like 63% since I bought the stock in 2017, so it's not the end of the world. Could have been a lot better though, better performer. But anyways, overall, it was an amazing year. I just wanted to highlight a few stocks that did well or did bad in my portfolio. Most of the stocks pretty much followed the market, so they're up 20, 25, 30%. And overall, so far, I think I'm pretty much on par with the market. I'm not ahead, but I'm not really behind. So it's going to be a good year, but I will. It's hard if you focus on dividend paying stocks to beat the market when the market is up by more than 20%, because usually it's driven by growth stocks, which I do have with my low yield high growth companies, but it's not pure growth play either. So anyways, I'm super happy with the year. I hope that you are happy about your year too. Go into comments on YouTube, share with me your best performing stocks. Going to give some ideas, and your worst performing stock too, because it could also give ideas for those that may bounce back in the new year in 25. All right, guys, that's enough for today. I'm going to talk again tomorrow for Business Friday. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.